All right, guys, what's going on, everyone? Good morning. Happy Saturday, first day of February. Give me a little shout out. Like a lot of you already know the drill. What's going on? I recognize a lot of the faces in here. Give me, I gotta know what you're drinking. I always have my morning coffee here, and where you're from. And if you want, who you're rooting for in the Super Bowl next week. Um, I want to let you guys know this is going to be the first Super Bowl I haven't watched in like 30 years because I despise both teams. As a 49ers fan, for me, it's tough to root for either one of those teams. But if they're your teams, that's all right. I got a lot of Philly fans. Let's see here. Richard, what's going on? Richard's from New Jersey. Zameen from Manchester, UK. I think I've talked to you about this before. My wife is from the UK. Caesar, what's going on? Caesar is a regular in these things. Tim from Chicago as well. Doesn't need his morning coffee. Jeff, what's going on? Felice, how's it going? From PA. Okay. I'm guessing you're rooting for the Eagles. Jatin from Canada. We're going to talk a little about Canada today because who knows how the market's going to react to those tariffs that are supposed to go into effect today. We're going to talk a little bit about that. Really tough to gauge what the market is going to do in related to that. We were actually going to take some positions on Friday and decided not to because we just don't know how the market's going to open on Monday. Tim, Jeff, what's going on? We got Mike. Mike's a regular here from Knoxville, Tennessee. We got Carolyn in here from she's new. I think this is her first one. Mike, what's going on? Trader Joe's roast. I used to drink that quite a bit. Mike's still rooting for the Lions. Richard's got the Eagles in caps. Must be a big Eagles fan. We got Brian from one of my favorite towns, Vegas. Howa from Flushing, New York City, where Peter Parker grew up. I'm a big Spider-Man fan. I almost wore a Spider-Man hoodie today. Keith, what's going on from Lexington, Kentucky? Daniel from Arkansas, Dark Brew. We got Dennis from San Francisco. Is happy that Salah is back with the Niners. So am I. I think he's going to turn around our defense. Paul from Maryland. We got Eric from Eric, my buddy from Palm Desert. We got to get together soon, Eric. Let's see here. I hope I haven't missed anybody. It's a big turnout this morning. We got Ronald from Texas, but rooting for the Eagles. We got Rodolfo. I think I already mentioned you. Sorry about that. This thing's moving really fast here. PT from Utah, Cowboy fan. Also hates both teams. I would imagine you would definitely hate or dislike Philly. Simon from Canada. We got Carolyn's from Dallas. We have Dan from Tampa. What's going on? Dan, like many of us, is tired of the Chiefs. We've got Drew from Ontario. Thank you for giving me your nickname because it looks like your first name is really hard to pronounce. Rooting for the Chiefs. Felice is drinking chocolate mint oolong tea. Wow, I've never heard of chocolate mint tea. All right. Good turnout this morning, guys. We got a lot to talk about. Monday is going to be very interesting. And I've already been getting questions. What do you think is going to happen Monday? I don't like to make those kind of predictions. I just like to prepare for it because we really have no idea, right? We can't predict news events or oftentimes how market is going to react to news events. We can only kind of trade what's in front of us. Even uh, you could talk to a economist and they don't know what's going to happen in the market. It's just how we prepare for these things. So we're going to talk about a little bit about that today. I think it's a good time just to get started to be cautious. And when I say cautious, that doesn't mean be completely out of the market or not trading. But what it does mean is really dig into only the really quality setups. Sometimes we can loosen up the setups because we have good risk reward or we think a stock can really move. So only quality setups. I do take smaller position sizes generally. And, as a good swing trader, it's not just setups, it's this overall kind of portfolio approach to how you're trading. And part of that is, whatever your account size is, how much of it are you trading? Trading 20% of it, 100% of it? Are you going on margin maybe and going a little bigger, 150% of it? And I definitely wouldn't be doing that right now, or even be at 100% right now, with the amount of unknowns and market volatility that there's potential for next week. So maybe you go like 50% of your account side, or with your trades, if when you stop out, you normally risk one or 2%, maybe go 0.5 or 0.7%. That's kind of approach I think we should have going into the week. And then once the week starts and we kind of see what's happening with the market reaction, what's going on with these tariffs or any other news events, then we can open it up. I was ready to open up, and we're going to talk about it why in a second. But then the tariff news hit on Friday, which we knew were in play, but the fact that it's this Saturday now, because it really felt like they were just threats to negotiate with, and now it seems like it's obviously a little more than that. Okay, so that's kind of an intro on how we're looking at the market. Let's actually, since we're on that talk right now, let's actually start with our market analysis. I was going to start with some of the earnings setups that we're seeing. But let's actually start with our market analysis. And as we're going, if you guys have any questions, you can post them in the chat here, related to what we're talking about. And at the end, we'll talk about questions for other stuff and tickers that you guys want me to take a look at, or stocks that you want me to take a look at. All right, and you guys know you can take a snapshot here. Let me actually put this in the chat. This is my contact information. And of course, you guys are all part of the Bulls family, even if it's your first time in here. So I get back to all of you guys. singjd1@aol.com. I know last week I got a bunch of emails related to my layouts on TC2000. And again, if you want those, email me with your nickname. If you're on TC2000, it's on the right-hand corner here in blue. And I'll send my layouts through TC Mail to you here. But email me, singjd1@theoldschoolaol.com. Of course, Bulls on Wall Street, swing trading. If you go to the swing section here, there's a 14-day free trial if you want to get the report videos that come out every day during the weekdays, and of course the chat here, which we're talking obviously every day in there, and the alerts as well. So you can join that if you want. The Bulls on Wall Street blog, I post there all the time. My own site, Paul J. Singh, I post there pretty frequently as well. And of course, Twitter and Instagram, I'm posting there just about every day. And did I get that I don't think I got that in the chat. Let me give you guys my contact info here, and then we'll get started. All right, you guys should have my contact info. Richard is mentioning that he's a member, just signed up for another year. All right. Okay, so let's talk about the market. And again, if you guys have any questions or comments, or you can illuminate on some of the stuff I'm talking about, you can just mention it in the chat here. Last week, when we got together here, we talked about how we had a bunch of news events kind of out of the way, and the market had reacted well to them. We talked a lot about gap down reversals and how the market tends to overreact to short-term news. Last week, it was related to AI and quantum computing, and especially DeepSeek. That was the Monday event, right? And the market had gapped down. A bunch of stocks, especially related to that field, AI, software, some of the big techs, some of the semiconductors like NVIDIA, related to that DeepSeek news, gapped down. And we talked about how those kind of things tend to be overreactions. And we're seeing that a lot of these stocks have come back now. So that's what we're going to be kind of bracing for on Monday, is what does the market do, and is it an overreaction to what's going on? And we see that with earnings as well, and we're going to talk about that in a second. But this week, we had a new set of news events. The big ones were one, Fed Day on Wednesday, and the market reacted very well to Fed Day. Let me actually pull up SPY here. And when I say the market, I'm generally talking about SPY, IWM, and the Qs, and we'll start with SPY here, the S&P 500. And if you guys, Felice is saying he lost his connection. I don't know if it's from my end or not. Did any of you guys lose your connections as well, or is everything okay? Hopefully I'm not talking to, okay, all good. All right, thanks. Okay, so you can see here, this was Fed Day. And notice here, so we've been getting rate cuts, and that's obviously what the market wants. And we knew pretty much that come Wednesday, the Fed was not going to cut again. And it was pretty much a given that the market was going to pause. So, the market already knew that, and that's kind of, all the movements we were seeing in the market were with that knowledge that that the Fed is going to pause right now. The key was going to be what in the commentary and in the release, what do they say about the future? What are they saying about inflation? Do they mention anything about starting to raise again, which obviously the market does not want to see? And they also wanted to see, does the Fed talk about reacting to anything Trump is doing? And those were kind of the key things we want to see. They didn't mention reactions to Trump very much. And they were pretty much saying they're going to be data driven. They didn't indicate anything about raising rates. So I think the market liked that. Notice it was a red day, but it wasn't a big kind of down day. And the candle was within the previous day's candle, which is called an inside day. So that day, what we had talked about over on Bulls on Wall Street is, even though it was a red day related to the Fed, it was actually a pretty healthy candle for us, especially after the big gap down. After there's been one big gap down related to a news event, then the market tends to be squeamish, and any other bad news, you're going to get continuation. We didn't see that. But as usual, the kind of standard for us on Fed days is we want to wait about 3-4 days. Usually they release on Wednesday. The next Monday, Tuesday is when we really get a good indication of what the trend is going to be post-Fed. So I tend to be very cautious, like the Thursday, Friday after Fed, and then really ramp it up if I see something good Monday or Tuesday. But we kind of threw that out the window because Friday's action was so good that it felt like, okay, the market's just happy to get the Fed out of the way. But we didn't get any fireworks from the Fed, and that was good. And we got a very strong candle. So we had decided on Friday we were going to start adding. We already have a number of positions, but we were going to start really adding. And literally just before going to start adding, the tariff news came out, and you can see how the market reacted. The market was very strong early in the day. And if we pull up the 5-minute, you can see here the market gapped up slightly. It was very good. And then it continued to run. And the reason for that is the PCE numbers were in line with what we wanted to see. The Fed watches the PCE very closely. These are inflation numbers. Came in at 2.8%, which is what the market wanted to see. The market wants to see these numbers not increasing and in the 2 rate. They wanted to get down to 2, but in the 2s is good. It's 2.8% here. So the market liked that because the market's always looking at what is the Fed going to do going forward, and it doesn't want to see anything that makes the Fed want to increase rates to combat inflation, right? So we had good news in here. It felt like, okay, now not only did the market react good to Fed Day, now these good inflation numbers came in. We're going to start to see really nice trends. SPY's at near all-time highs, ready to break out and make another run. We've also had a pretty good earnings season. So all these were aligning well. But then the tariff news came out. You can see on this intraday chart exactly when it happened, right? Right in here, boom, we had the gap up. We had a nice day, nice trending day. Then all of a sudden, look at these big, big candles, and then a very weak close on Friday. So we scrapped our plans. We're always adaptable, right? We're not, when you have a market opinion, you should never be like, I'm right, and I want to be right. You should be able to adapt like that. And we decided, okay, you know what? We'll keep the positions we have on now, but we're not going to add anything here. And that's kind of how the market played out going into the weekend. There's uncertainty now. We don't know what's going to go on with the tariffs. And the reason the tariffs are so important to us, we don't care about the politics behind it. We don't care about the strategic maneuvering related to the tariffs are sorry, excuse me. The tariffs are related to percent, and then Mexico and Canada 25%. And we don't care about the negotiating tactics, the policy, the politics. We don't care about any of that. What we care about is what does the Fed think, and how is this going to relate to inflation? Obviously, tariffs are going to have an impact on that. And now, what is the Fed going to do? And this could be just a very strong, negotiating tactic, right? And maybe everything goes good today. Maybe during the week there's some negotiating goes on and things change. Who knows? But the point is, this brings uncertainty. The market doesn't like that, and the market doesn't like anything right now that the Fed is going to be watching, right? So that's why this happened, and now we have to see what happens. How does the market react it on Monday? Who knows what the news is going to be again? But does the market gap down on Monday, or do things change and we hold a 9 EMA and things get better? So we're not going to guess that. We have no idea. We're just going to wait and see what the market does. So that's kind of where we are now related to Fed day was good, inflation numbers were good, but now we have the question mark here. That's why I have the question marks on tariffs. We have some uncertainty. Another news event was earnings. We know we've already had the banks out of the way. It was a big week for big tech, and we'll talk about that in a second. The reactions to earnings with Tesla, the big ones, Tesla, Apple, Microsoft, and Meta, were all good except for Microsoft. So, we hit on 3 out of 4. That's pretty good for the overall market. The big tech is very heavily weighted in SPY and in the NASDAQ. So it's good that we had pretty good earnings related to that. Apple got iffy towards the end of the day, and we'll look at all these in a second. And then now this coming week, we have some more big ones, especially with Google and Amazon. And once we have that in, we basically have all of the big tech except AMD and NVIDIA, which will be reporting, I think, in the middle of February. So that's kind of where we are with the market right now. And how we should be. So the reason we do this market analysis is essentially to give us kind of the blueprint for how we should be thinking about trading, right? It's not necessarily, we're not usually trading, unless we see a really good setup, trading SPY or trading the Qs, but it lets me know what setups I should be looking to trade. Should I be mixing longs with shorts or shorts with longs? How aggressive I should be with my trades. And that's kind of where we are right now. Okay, all right, so that's our market analysis right now. Really quick, let's take a look at market breadth. Again, most of you are regulars here, so you guys know SPY, talk about this every time. SPY is not equally weighted. It does have 500 of the biggest and best stocks in it, or best companies in it, not necessarily the best stocks to trade, but 500 of the biggest companies in it, but it's not equally weighted. Tesla and Apple make up about over 3% alone when they should make up only 0.4%. And the top 10 holdings make up about 35%. Most of them are related to big tech. So RSP ETF equally weights everything. So Apple, Tesla, Google are not worth any more than BEN, EMN, VRTX, and so on. So notice here, first let's look at SPY. We can just eyeball it and kind of see. You see what SPY was doing. And if we look at RSP, RSP is pretty much in line with RSP, so no negative divergences or positive divergences right now. If we look at the Qs, and then we can look at QQEW, which is the equal weighted, actually a little bit of relative strength here in QQEW. And then I also like to look at T2108, which is stocks above their 40-day moving averages. We want to see strength here, and we are seeing overall a lot of strength here after being very weak and getting oversold here. Stocks above their 40-day moving averages, very strong, right at the 200-day moving average now, and of course pulled back yesterday with the tariff news, but overall very strong. So market breadth is pretty good. We just have to see now how the market reacts early in the week, and I think we'll get a good indication of what the market's going to do early in the week. All right, and that sector rotation we talked about is still in play. I posted a chart in our chat. I don't know, a few days ago. Let me see if I can find it real quick. Um, okay, yeah, here it is. So we've been talking about industry and sector rotation and some other areas becoming kind of momentum plays instead of some of the other areas we had been looking at before, like power plants, tech, and so on. And you can see here, communication services, 6.6%, healthcare, 6.4% date since January 1. Financials, 6%, materials, 5.5%, industrials, 5%, consumer discretionary, that's essentially a lot of retail, 4%, energy, 4%, and so on. And then we see down here, utilities, which had been very strong because essentially that's power plants, and a lot of power is needed for AI and quantum computing. But DeepSeek kind of threw a wrench in that because it takes less power. So only 1% compared to the 6% and 5% here. And then technology down 0.5%. So we definitely see a rotation into these other areas, and we should still be paying attention to that, to these areas. So that's pretty much our market analysis right now. Now let's get to what we can actually look to trade. So a bunch of stocks we're going to look at here. Got one question here from Tom. If you guys have any questions, you can go ahead and post them now. If a stock is slowly trending up over a month or two with a tight 9 EMA, is it okay to enter? If the overall pattern is strong, that would be essentially what you're describing is a continuation pattern. And we see a number of stocks doing what you just described, Tom. I would say with that, when we have continuation patterns, there's two optimal places to enter. So if it's slowly moving higher, but it has been moving higher without any real dips, that's kind of a tough spot, excuse me, to enter because we're always talking about risk reward. And in yesterday's the stocks and coffee, and if you need the link, you can go into my X or Twitter from Monday or over the weekend. I had posted the link to it, but we did a good analysis of risk reward and how impactful that can be. If you're entering here, you never know where the dip is going to be, and you have to place your stop at a logical level, and it's probably going to be pretty wide. So you're not getting good risk reward. So our setups for continuation patterns tend to be in two spots. When we get a dip and then a little bit of strength, you can think of that as buy the dip. That's where we want to enter. Usually it's at a key level, like where there was some price action support, or the 9 EMA or the 20 MA or the 50 MA, somewhere in there is usually where it'll find support. We want to enter there to where we can easily place our stop under that range. And let's say we're entering at 100, we place our stop at 98, and now when it dipped, maybe the top of the range here is 105, and then we can risk essentially 2 points to make 5, and we always want to be able to gain more than we risk, and that's a good 2.5 risk reward. Every dollar we win, every dollar we risk, we can make 2.5. And think about that. If you're at a 50% win rate on all your trades, when you lose, you're only going to be losing 1. When you win, you're going to be winning at least 2.5, and you're going to be making essentially per trade, you're actually essentially making 1.5. And if you multiply that 100, that is a huge amount of winning. So my thing would that be watch those stocks that are trending, watch for the spot where they pull back and you can enter, or if they're shallow pullbacks or consolidations where they break out over that range, then you can place a stop under the range and trade the breakout. So those are the two spots I like to use with the setups with the stocks that are moving the way you described there. All right, if you guys have any other questions, let me know here. All right, let's talk about some stocks here. Last week we talked about the gap down reversal type setups. We talked about how the market's very skittish, especially when we've been in strong trends, and then we've got all these news events coming out, and especially related to earnings as well, when we get kind of negative reactions to earnings. And it sounds counterintuitive because when a stock is gapping down, there's usually bad news involved, and you would think, okay, you want to short it. But these gap downs tend to be overreactions, and you often get these big gap downs, and that's essentially the extent of most of the move. And then you get quick recoveries, or they gap down, they continue down a little bit, and eventually the smart money will come in, buy it up, and then it goes back up. And we see a lot of examples of that right now. I'm going to go over a bunch of these gap downs that I am tracking right now. Let's take a look at some of these guys. Some of them just gap down, and some of them have already put in the reversals. Let's start with some of them that have put in the reversals. CRDO. This one was not related to earnings, but this really illustrates that gap down setup, and we've seen a lot of these. Notice here the big gap down on that tech-related news, and look at how quick the recovery was. And you can see here, let me actually go over some of the setups here. There are a few setups I really like on the gap down reversals. So these are daily candles now. And so here is what I'm drawing here is this previous day's candle, and then we get the gap down. And there are a few levels that I'm looking at. The break into the gap range, where it gapped down from. And the setups that I like to trade are: one, if it pulls into the gap; two, if it continues down and then you get a reversal candle, or the 9 EMA is trailing like this, and then you get a break above the 9 EMA. That's a good spot to be entering on these gap reversals. And then when it finally kind of completely reverses and breaks where it was before the bad news, that's a very good spot to enter. Often you get these huge momentum moves when that happens. So those are the kind of the three spots, and you can see very clearly with CRDO, this essentially put in this setup here where it pulls into the gap. It did that on Friday. So, and notice here the relative strength. A lot of stocks were pulling back on Friday. It did pull back off its highs, but it still stayed green. So it pulled into the gap. That's kind of a trigger for the entry. And you can see you still have a lot of room till it hits that gap around 80. So that's a good 10 points. Maybe you could risk like 3 points here. And your reward would be 10 points. So that's 3.3 to 1 on your money here. And you can get out here. And if it were to break this range, it's actually setting up to go on a momentum trend after essentially invalidating all that bad news. So this is a really good example of that. That is CRDO, ALAB, ARM, very similar setups here. You can see ALAB right at that gap level. What was the other one? ALAB, and then ARM and NBIS. Here's ARM. Look at the gap down. This one is testing that gap range now. And then NBIS. Eric's mentioning EA. That one is on my list. Now, these ones I'm showing you were not related to earnings. They were related to that tech news. But let's look at some earnings one now. So CRDO, ALAB, ARM, NBIS, VST is power plants, QBTS is quantum computing, NVIDIA related to chips and AI, ISRG, I think I put it twice, I guess, because part of it is related to the tech thing. It's a biotech company and medical devices, but they're also very heavily in AI. TSM is related to that as well. These other ones were earnings gap downs. And the one Eric is mentioning, EA, is an earnings gap down. I don't remember the news on how far they missed, but notice here. So this is where earnings was, and it was a strong stock. I especially like when we see earnings gap downs in stocks that have been strong, stocks that have good revenues. And I have this where I track growth and fundamentals and institutional ownership. So I'll look for stocks that have been strong related to that, and then also have been in strong trends. And EA was in a very strong trend. I had been pulling back some here, but then gap down on earnings. And notice here, this is pretty much that. EA, Eric pointed out a good one here. Gap down, consolidated, and on Friday into the gap, halt 9 EMA, adds another form of resistance. But I think if it gets above the 9 EMA, you have a very good setup in. There's still a lot of room before it hits this gap down resistance up here at 142. So that's a very good example. I should actually have this one in my list here. Let's look at a few others here. We have SoFi. SoFi gap down on earnings. This is a kind of a fintech credit services stock. You can see here, it gapped down on earnings here, kind of consolidating here. If it were to pull up above the 9 EMA, We have a good target at that gap fill. Now and LMT, now is software. And you can see the big gap down here on earnings. It started to pull into the gap the very next day, but pulled back. But I'll be watching that gap range very closely with now. And you can see now has been a very strong trender and gapping down. We have LMT, which is a defense stock. Defense has been very strong. This one was pulling back for a while and then gapped down here. And I usually don't like to do this in stocks that have been in strong trends or strong downtrends. But that being said, LMT is a stock that has kind of been in play and defense has been in play. So I'll track it still. You can see here, there's nothing to do with it right now, but if it were to pull into the gap, Dennis is asking about UPS, and I have that on my list here as well. So UPS gap down on earnings. I don't think there was a big issue with the earnings or revenues. What was concerning was their guidance. Those are when there's earnings, there's three things you want to pay attention to. And really just look at the headlines. It's not a lot of work. You can go to Earnings Whisper. That's a good spot to get some of those numbers and the guidance. If you just go on to CNBC or any of the sites and just put in the ticker of that stock that had earnings, you'll see the news event related to that and the guidance. So we look at earnings and did it beat estimates? Was there earnings growth? Revenues and did it beat revenue growth and estimates? And then their guidance. What do they actually say? So you don't have to go and read these big earnings reports. Just look at the headline. And with UPS, they said they are something about I don't know why they would do this because Amazon must be a huge business for them. But they basically said they were gonna do less shipping for Amazon and less reliance on Amazon, which was a little surprising because I don't think Amazon said anything. UPS said this, which I don't know why they would do that, and the market doesn't either because you see the big gap down now. That's a little concerning because that's a big part of their business, right? So there was a gap down here. Now, is this a good candidate? I don't know. Because one, the stock has been in a downtrend for a while now. But that being said, it has been a good bounce play, but then it hits resistance and starts its next downtrend. So you could still profit from these moves. My thing with UPS is where I said they tend to be overreactions. UPS's guidance is actually kind of bad news. Like, Amazon's such a big part of their business. So I don't know if this is the best candidate. That being said, what we're really beholden to is our setups and price action. And if it does pull into the gap, you can still trade it as a potential gap down reversal. Now LMT, we talked about ManH and WHR. Here's ManH. This is software application. And you can see here, look at how strong this has been trending for the last year and a half. And then here, the gap down, I would watch for the move into the gap again. Or if it continues down and gives a strong reversal candle. We have WHR and JetBlue. Here's WHR, Whirlpool. Always remember that these home furnishings, home furniture, they're very tied to the housing market because, when people are buying new homes or building new homes, they need this stuff, right? Furniture, Whirlpools type stuff, washers and dryers and all that kind of stuff. Had the big gap down here, has been in a pretty strong trend. And it's gapping down to a major support level too. So this is one very interesting to watch. If it pulls into the gap, I would definitely be watching that one. JetBlue has been strong. Airlines have been strong. And then you can see the gap down here. Looked like it was going to close in the gap, but reversed with the rest of the market on Friday on the tariff news. And then obviously we'll be watching this range. So it is definitely one to watch. Let's look at one more, ISRG gap down. This has been one of my favorite trending stocks. You can see here, this is related to medical devices, related to biotech. So it's good in that regard. It is a strong mover, but also it's one of the leaders in AI in that field. So you get the advantage of that when you're trading it. But like the rest of this AI kind of stuff, it gapped down here, and it also gapped down on earnings. And you can see here, has held up. And I would definitely watch this range very closely around 590. If it pulls into that range, we could target here up at around 608 for a potential trade. And then if it broke that range, obviously back on trend. Okay, so those are the gap downs. A few of the gap ups. Starbucks, FFIV, the banks here. Let's just look at Starbucks. Starbucks had a very good reaction, which is interesting because their numbers weren't great, but they did beat expectations. And you can see here the big gap up, starting to consolidate. If it doesn't pull back, I would watch this consolidation, and if it breaks a range around 110, I think you have a very good entry in Starbucks, and it could set up a move. And you can see we have a high here around 128. So still a lot of room to hit a major resistance level. CHKP is another good one. And you can see the big breakout over this range here. I would watch for a potential pullback play in CHKP. And now let's look at some of the big techs. So Meta gapped up on earnings. Now, we had talked about this before earnings on Meta, that even though it's been very strong, if they blow the roof on earnings, I would be hesitant to play that gap because it's already so extended, and that's kind of what's playing out here. Notice this candle here. While it did gap up, very volatile. At one point was break even on the day. At one point was up a lot and closed up about 2%. But it had very strong numbers. And I think the market also likes that he's Zuckerberg has become very tied into the current administration. So he might get some favor with that. Tesla's kind of in that spot right now as well. So you would have expected a huge breakout, but it didn't get that. I think part of the reason is it's already so extended. So I'd be hesitant on Meta right now, even though it's a very good stock. What I want to see is a little bit of a pullback here, maybe to the 9 EMA. That would set us up very nicely to get into Meta. Netflix had the classic earnings breakout and now has been consolidating. So I would wait for a break of the consolidation range. If that happens, like say it breaks here, this maybe 995 range or 1,000, you don't even have to think about it. It's a no-brainer. You should be entering that. Now, for those of you who have smaller accounts, I know it's a little daunting when you see $1,000 stock, but think about it. This thing going to 1,100 is like your $10 stock going to 11. If it goes to 1,200, it's like your $10 stock going up to 12, a 20% move. So it doesn't matter. If you have less shares at this price, you're still getting the same kind of gain, right? If it makes that percentage move. And if it can make that percentage move, which Netflix easily could, you can see here, it just recently made a 20%, almost a 20% move. So I wouldn't hesitate because of the price. You can take less shares, but again, if it can move 20, 30%, that's fine. Google, Amazon are next week. Apple was interesting here. We're going to have to stay away from it for now. Apple's had some bad news with the China numbers. It's dropped to number 3 in phone sales in China, and their revenues are declining there, and obviously that's a big part of their business. Their earnings was mixed as well in that their phone sales declined. Their revenue from phone sales declined. A big part of that is related to China, and obviously the tariffs are going to have a big impact on Apple as well. But their services, we know Apple has a big chunk of what they make is from their services, blew the roof on services. So the market really liked that aspect, and it was gapping up 4 or 5%. After hours, it was gapping up over 5%, but when it opened, 5%. But when the tariff news hits, Apple is really sensitive to that. And even though it had strong earnings, it reacted very poorly to that. Only down 0.67%, but ugly candle, right? When you consider where it was intraday. So how do we look at that? I would just watch right now. And the only way I would trade Apple is if it can get back up over the 50-day moving average and maybe even above this candle. So I'd be a little cautious with Apple right now, even though some of the numbers were good. Microsoft is stay away from right now. I know we talked about overreactions and the gap downs. We like that, but this is just kind of a ugly range and pattern right now. So I would hold off on Apple. And then AMD, NVIDIA have earnings coming up actually at the end of the month on NVIDIA. So this gap down was related to the tech news. Maybe if it pulled into this gap, we could potentially play NVIDIA. But obviously the China tariff stuff really impacts NVIDIA. And there was also a lot of talk of curtailing the big semiconductors companies like NVIDIA sales to China, and obviously that would impact NVIDIA, and that's why NVIDIA has been doing so poorly after this huge run. All right, so those are some of the stocks I wanted to go over. Let me actually go over Delta one more. We talked about SkyW or the other airline that had gapped down. Delta has gapped up. You can see the big gap up here. Pulled back on Friday with the rest of the market, but I would watch this range very closely if it can break that range. Some other stocks I would watch, some of the stuff directly related to the tariff, we can call like NVIDIA and Apple indirectly related, but directly related would be some of these China, Canada, and Mexico ETFs. So FXI is China, and the ETF had been really recovering. It had been doing very poorly since the election. You can see here, trending down. It had broke that trend, and since mid-January was in a very strong move. But obviously now the tariff stuff, we have to watch it. But one of the things I was considering entering, and I'm glad I didn't now, was BABA. You can see the strong move there. Baidu, KWeb as well, some of the China companies. You could also do Yin, which is a leveraged ETF. Yang, if you want to short, you can just go long Yang. So all of these guys are in play. For Canada, you can use EWC, and you can see here's the ETF, and it had been doing poorly, essentially since post-election, all the talk of, Canada being our 50th state and tariffs and all that. You can see the big move down, had recovered, but now you can see what it did Friday. And then Mexico's ETF is EWW. And you can see here, pulled back on that news after a nice bounce. So we'll see. I would watch these very closely. If any good news really comes related to the tariff stuff for these countries, these things will probably explode. So I would watch these very closely. Then some of the stocks we talked about last week, SFM, PLTR, TJX, Lulu. I won't go over all these charts again. We talked about them last week. But all very strong stocks right now. Lulu, SE, Coin, Melly, Gap. All of them have earnings coming up, but we've got some time. I think PLTR is next week. But if you've got 2-3 weeks on some of these, like I think Lulu, we have some time. Yeah, 320. We could definitely play some of these guys as well. All right, so that's what I want to talk about today, guys. If you have any questions or any tickers you want me to cover, post them here. Remember my contact information. You guys can contact me anytime if you want my layouts, singjd1@aol.com. If you want to join the swing service and see the report for Monday and get in the chat room, again, go to Bulls on Wall Street, swing trading, 14-day free trial. You can click that right here. I'll actually put the link in the chat. Or you can join at the monthly or the annual rate, which is cheaper. Here is the link to the free trial. Raymond, I went over SoFi already, but I'll go over it again. That's all right. We can see SoFi here had the gap down. Doesn't have earnings now until 5/5, so we don't have to worry about that. So I would be watching this gap range very closely. So if it pulls into about 1675, I think you have an entry there for SoFi. All right, a few more questions in here. And again, if you guys have any tickers or any questions you want me to go over, I will go over them. Oh, and yeah, you guys had more questions than I thought. Okay. Yeah, that's always tricky, Jeff. Jeff is asking, and SoFi is a good example of that. For the gap, technically the gap is where it closed. So, down here, right? That's the gap. And the question is, do you consider the wick for the gap or the body, right? There's no right answer for that. Generally, I default to, because where that tail is, it's usually not a lot of volume. But I will go in intraday, and if it looks like there was a lot of volume where the wick was formed, then I will use the wick. So my default is to use the body. Go into intraday and see there was a lot of volume in here, then I would consider the wick. So you have to kind of analyze it a little deeper. Valerie is asking about Hut. I think that's a software company, right? No, Capital Markets. I've never traded this, so let me take a look here. This would definitely be a potential gap down reversal, but it looks like it has earnings on 2/12. I don't know what the gap down was related to. It's probably the Monday news. Before that gap down, what I really liked, there was a lot of accumulation in the stock. So it's obviously the institutions like it. So I would definitely watch this for a potential gap down reversal. WBA, I think Aaron's asking for that one. Yeah, Aaron, this one gap down. This one's interesting here because my initial reaction was not the best stock, but it does look like it's bottoming. And what I really like on these bottoming formations, notice here how we identified it as a bottom is notice here it had been in a downtrend of lower highs and lower lows, right? The bottom formation changes that. All of a sudden, we get a higher low here and a higher high here. And within that range, what I really look for is their buying. And look at all these big green candles. So this is a very nice stock for a bottom formation. And Walgreens had broke out on earnings, so it was definitely in play. I'm not sure what the gap down is related to here on Walgreens, but I definitely would watch it at the 50-day moving average. I wouldn't enter yet, but if it starts to improve, I would definitely watch it. And I'm not sure if you know what the news was on this gap down. IONQ, I'm actually in this one right now, Simran. IONQ. And you can see here the gap down. I don't remember exactly when I got in, but you can see it pulled into the gap here. This is a quantum computing stock, one of the big quantum computing stocks. And I do like this one here as long as it's above the 50-day moving average. Kareem is asking about HUT. I don't think of it for this one. I would be looking. Did I put the wrong ticker in? So for some reason, I totally missed on your question. I thought that was the ticker. You said shoot. Okay, Kareem is asking, what's a good percentage return? So when I enter a stock, I don't look at it in terms of percentage. I know I said percentage with whatever stock, with the big stock. I forgot which one. That was trading around 1,000. It was one of the big techs. But I look for risk reward, right? So, for example, let's say you have a $10,000 account. And same analysis goes whether you have a $100,000 account, $1 million account, doesn't matter. If I have a $10,000 account, I generally want to risk between 1% and 2% per trade. To make it easy, let's say 1% for the calculations. That means I don't want to risk more than $100. You never want to trade to where it hurts you, right? And if you have a $10,000 account, you lose, who cares, right? You're at $9,900. That's not really impacting you. So practically the same amount, right? Now, if you risk $500 or $1,000, you're trading too big because that one trade is going to take you from 10,000 to 9,000, and that's not good. You lose 3-4 trades in a row, you've lost a huge amount of capital, right? Whereas if you lose 3 trades in a row at $100, no big deal. You're down to 9,700. So generally here, I would want to be risking between $100 and $200. So I'm going to look at the setup. Let's just say a stock I like right now, Melly. And I'm looking at Melly, and I say, actually, let me use a different one. Let's use SFM. Okay, SFM's trading at 158. Let's say I'm going to take, I'm going to use a 5-point stop around right at the 90 MA, so around 150, or actually it would be a little lower, but let's just say 5 point. Let's say I'm going to use a 5-point stop. So in that situation, I'm going to take about 20 shares so that I would only lose $100. And then I have to be able to make 200. So I'd have to be able to have a 10-point gain. So in that situation, it wouldn't quite be a 10% move in the stock to get me the 10-point gain. So that's the kind of analysis you should be doing, not a percentage gain. But if I risk 100, am I able to make 200 on the trade for that account size? Marcos is asking about NVIDIA. I think I did that analysis. Maybe you asked before that. With NVIDIA here, I would only trade it if you have 2 weeks going into earnings, which we still do, And if it pulls into the gap here around 130, and no, NVIDIA is likely to be very volatile related to any news events related to tariffs, China, and so on. So that's one thing you want to know. Like, there's a lot of volatility related to this news, and do I want a stock that's very tied into those news events, or do I want one that really is not impacted by that? Tom, I think I answered your question related to the gaps. Dan is asking, should we be playing with trading smaller position sizes and tighter stops? So I think the way to think about it is you should be risking less right now. Anytime the market gets volatile, and when I say volatile, I mean not to the, like, if volatile could be in one direction, right? But if it's volatile to the upside, that's great, you get bigger. But in this, where we don't have an edge and we don't know where the volatility is going to be, up, down, so on, right? In that regard, whenever you're in this kind of indecisive kind of market, you want to trade with less risk. So if your risk is usually 1 to 2%, you want to go down to like 0.5 to 1%. So that's the way I would look at it. And you can do that by taking a smaller position size, or tightening your stop, or both. But just pay attention to your risk less. Robert is asking about Home Depot, HD. Looks like it has earnings on the 25th, so I wouldn't trade it. Once you get into 2 weeks, you can be holding, but I wouldn't enter that. We had a gap up, is pulling back. I think it's a good stock right now. Watch the 9 EMA and the 50-day moving average, but the overall pattern is nice with HD. Okay, Dan's asking about Road, and it was a gap down. I have never traded this stock, and I can't remember having it on my focus list. Very nice trend. I'm surprised I didn't have this, because I have been paying attention to engineering and construction. I don't know how I missed this one. Low floater, that's good. Nice trend. A deeper, I always get concerned when stock has been in a nice trend, tight trend. The pullbacks get bought up very quickly, and then you start to get deeper pullbacks. That's where you start to get a little bit of concern, and there's been some distribution here as well. Did gap down. Let me look at the revenue trend here, since I don't know much about revenue. They've been declining some, but not too bad. I think this could be a potential gap down reversal, but you need the signal. So just because you identify it as a potential doesn't mean you just enter. It would have to pull into this gap here around 85 for me to enter, and it's at 80 right now. But good stock to watch. Jared's asking about BLND and TEM. So TEM is a recent IPO, has an IPO high here of 79.80. By the way, it's getting close to its IPO high. I love when IPOs, like somewhere between a year and 2 years out, even 3 years out, break their IPO highs. So if this thing does break 80, it's kind of like a no-brainer. Just you enter, place your stop under that range. You risk like 1 or 2 points to potentially get 20 or 30 points. That's how strong these things can move potentially when they break their IPO highs. For now, a little extended, maybe on a pullback. And then with BLND, nice trend. I'd probably wait for it to remount the 50-day moving average. All right, we're getting to the point here where I have to get out, guys. Okay, thanks for that update, Aaron. I do have a list of inverse ETFs that I play, Richard, when I want to play the indexes. Remember, guys, we have the swing report. You can also go to any of these links here, my own site, Bulls on Wall Street. A lot of good stuff in there. A lot of great questions. Sorry about the coughs, Tom. I'm recovering from a little bit of sickness here. All right. Talk to you guys soon. We'll do another one of these maybe next week. And of course, those of you guys who are swing members, I will see you guys on Monday. Talk soon.